Heavy is the head that has to manage all of this.
Hey everyone, welcome back to my channel.
We're now incentivized to buy what we already buy.
Fumbling through college had me building.
I also got something done on the other side.
And that was right around, I would say, May, maybe right before renewing the lease for this property.
Welcome to the channel, Martha.
Thank you for having me here.
Oh, I was going to say, I am getting up there and age, I'll tell you what.
Bills paid by other people, life was never this good. I had to step back.
Hey. So a lot of people are interested in the stock market, but I still want to address something that is going to be very important in the next couple of months. So interest rates are set to go down, right? Everyone is expecting interest rates to go down. The market has been tight for a while, and so we understand that real estate investors, real estate buyers, property owners, people who want to get into the market for the first time, they're wanting a break, right? I literally just spoke to one of my mortgage lenders today. His name is Sean. And me and Sean went over a few possibilities for me. So Sean isn't able to do assumable mortgages. What an assumable mortgage is to assume the loan of someone else, right? So somebody who has a 2% interest rate, you can assume that loan as long as you pay the gap in the price. So maybe they bought it for $200,000 and they've paid it down to $180,000. But now, 5 years later, they want to sell it for $350,000. I need to make up the difference. So I need to pay from $180,000 to $350,000 in cash, or I need to find a lender who's willing to do a second mortgage on that property so that I can assume that 2% interest rate for the remaining $180,000 of that mortgage. Now, that secondary mortgage loan might be a 30-year mortgage, and that $180,000 mortgage loan that's at 2% is probably going to be 5 years off because, again, we're in a hypothetical situation where we waited 5 years. This is pretty nice because let's say you wanted to buy a $350,000 house. You just got $180,000 of that house at 2% interest rates, right? So regardless if you were going to pay on two mortgages or not, you just got that house at 80% interest rates. Now, the thing about your property taxes and insurance, you want to be paying that on one loan and not two loans because it's just going to make things complicated. You just want to pay your principal and interest to one lender, and you want to pay your property taxes and insurance, preferably in an escrow, because that's going to make things a lot more simple for you than having to balance paying your property taxes, paying your insurance every month or year, and then paying two different companies a mortgage as well. I like to simplify things in my life so that I'm not scatterbrained all over the place or stressed out about real estate. Now, this is a lot. This is high level stuff that we're talking about, and I'm going to continue to keep it high level. So if you need to pause this video for any reason, if a lot of this stuff is going over your head, I do apologize, but we're getting to the nitty gritty of stuff. We're here to really make people smart investors and understand financially where they're wanting to go with this real estate stuff. So I also want to preface that if you are a first-time home buyer, there are plenty of options available for you for down payment assistance. The problem with down payment assistance, however, is that it can have a fixed rate or a flat rate. You know, there was a time that I wanted a FHA 203K loan. What is a FHA 203K loan? It's the ability to use a FHA mortgage, but to rehab a property, right? So the 203K is to rehab the property. Now, because you're rehabbing the property, they believe that you're going to fix it up and potentially flip it or refinance the mortgage. And so this is also a fixed rate that is potentially a lot higher than should you have bought a primary residence, or even if you had bought a rental property. The interest rate is higher because they're giving you additional money to fix up the property, and they also have a lot of rules in place to where you have to use specific construction workers. You got to show who's going to do the work. You get paid out in phases. things like that, because they want to ensure that the work gets done, that the property gets fixed, and they actually expect you to refinance the property and get out of the mortgage. That's why they have so many fees and a higher interest rate up front, because they don't expect you to stay with the same higher interest rate. So for example, in this market, let's say that interest rate is about 7.9%. Even though on a regular mortgage with good credit, you can probably get a 6.7%, right? Now you're with a 7.9 because you need an extra $80,000 to fix up this property, and you're probably going to refinance out of it because you're going to have so much equity once the property is fixed. And so that FHA 203K loan, they're assuming you're going to refinance out of it. Now, with the down payment assistance, they're expecting you to stay in that home for about 5 to 7 years. If you're a first-time home buyer, you're able to get about 5% down as a first-time home buyer. If you're not a first-time home buyer, meaning you have owned a home for at least, you own a home now, or you have owned a home in the last 3 years, then you are not a first-time home buyer. And what that means is you are only able to get 2.5% on a down payment. So for example, if you want a $350,000 mortgage, they're able to give you on 2.5% about $7,450 or so. I didn't calculate that, so you can go ahead and calculate that if you want. It should be around $7,450 on a $350,000 mortgage with 2.5% down. Now, if you're a first-time home buyer, $350,000, you can get 5% down. You're going to be at roughly $16,000. Again, I didn't calculate that. It might be 15. So go ahead and do that quick math. Now, a lot of people might be saying, why would I want that fixed rate with the down payment when if I just put my own money down, I'm going to have a cheaper interest rate over the life of the entire loan? Well, I already did some of that math, and I realized that I would actually save $100 per month if I didn't use the down payment assistance and I just went for the cheaper interest rate. The problem with that, though, is that you're foregoing $7,500 in free money over the span of, let's say, 5 years to break even, right? Let's just assume 5 years you break even on that $7,500. By that time, you should have been able to refinance to a far lower rate, whether at a higher term of 30 years again, or at a lower term of 25 or 20 years. So what that means is that you can get that $7,500 up front that is paying down your mortgage, paying down what you owe on the property. And then when you decide to refinance, you find a lender that you can refinance cheaply, right? Maybe you paid $2,000, $3,000 to refinance the mortgage. You're not taking out any additional debt. You're just getting a cheaper interest rate. That might cost you about $4,000, $5,000. You still saved money, and you got a far lower interest rate than you would have, because again, we are expecting interest rates to go down in September by at least a quarter point. And, later on down the line, we expect interest rates to probably hit around the 5% again, which would definitely support a lot of home buyers, right? Because if this is the most unaffordable market there is, well, there's going to be a time when the market becomes more affordable. In order for that to happen, interest rates need to be lower because the housing prices aren't going to go lower, right? And so what that means is that it's basically like saying all cars are too expensive to buy. Nobody can buy a car. Nobody can even finance a car. If that is the case, eventually car prices or the rates have to go down so that the majority of people can afford it. If the majority of people can afford it, that means it is cheap enough for the majority of Americans to afford it. That is why I believe the American dream is going to be very much alive, and that if housing prices are the highest it's ever been, it's definitely going to come down, because guess what? the majority of people still need to be able to afford a place to live, or else there is no sales in America, and therefore everybody will be stuck in their homes forever. And the way the Americans are based on consuming, that's impossible, right? People want to get up, people want to travel, people want to relocate and move, and so they're definitely going to be focused on doing just that. Now, is this the highest interest rates that we've ever seen? Because a lot of people like to comment that these are not the highest interest rates ever. True, I've seen 12%, we've seen 14%, but we've never seen housing prices this high in the history of America. And therefore, with the interest rates being at 6 and almost 7%, obviously this is the most expensive housing market that we've ever had in the history of America. Now, in this decade, housing prices have gone up over 10%. That is the highest on record, to be honest. That is the highest in American history since 1960, which means for all my stock market people out there, good news for you. The stock market is going to make you a lot more money than the housing market. But I still encourage people to go out and buy their first home because, again, you're going to be building equity. You're going to stop renting. Now, if renting is cheaper than buying a home, obviously rent, save that money and invest it in the stock market. But if it is not cheaper than renting, you might as well go ahead and get a home. You might as well start to build some equity. You might as well start to build that net worth, right? So if you like this video, make sure you leave a like, comment, and subscribe to the channel. You know I post every single day at 8 a.m. daily on YouTube and on Rumble, and I can't wait to see you on the next one. Peace.